Welcome, everyone. Hello, and thank you for joining us for a investor seminar. In the participants, today you've got me as your host. I'm Joel Crane, the Investor Relations Manager. I'm joined by CEO Joe Katarevic and the Executive Manager Andrew Tong. The intention of today's webinar is to provide an update on the progress of the Broken Hill Cobalt project definitive feasibility study, as well as a summary of some other recent business achievements. Just in terms of the webinar format, we've got 45 minutes booked in total. Joe and Andrew are going to start with an update on the DFS and business achievements, and then I'll wrap up with some views on the current state of the cobalt market, and then we'll open up to questions to the team. Just in terms of housekeeping, technology and Zoom protocol, all participants are muted. If you want to submit a question, please open the Q&A box, type in your question, click send. I'm going to be moderating the questions, and thank you to all of you who submitted questions beforehand. Just in the interest of time, some questions may be grouped together, and if there's a common theme. And of course, if we don't get to your question, please feel free to reach out to myself, and we'll do our best to make sure that your questions and concerns are addressed. Okay, with that, let's kick it off. I'll hand over to you, Andrew, to start off with an update on what's happening out of the demonstration plant.
Great. Thank you, Joel. And thanks to everybody for joining us today. It's always great to have these webinar sessions and to meet you virtually. We look forward to some questions at the end. I'm just going to spend a couple of minutes talking through the demonstration plant and where we're up to. And I'll give you a little bit of context as well, so a bit of the history of where we are as a project if you're a first-time listener. Cobalt Blue's been developing the Broken Hill Cobalt project, 20 k's west of Broken Hill. You can see some of the land there in the photo to the left, which shows our underground portal that we put in last year in 2021. Last year, we mined around 7,000 tonne of rock out of that portal. And of that, around 4,200 was processed of ore through our plant to make concentrate. The remaining material was the portal development and obviously some of the interface between waste rock and ore. So we mined a bit more, but the numbers there show what was processed through the plant into concentrate. Why are we doing this? Our particular flow sheet in our project is to recover cobalt from pyrite mineral. Out there in Broken Hill, we have a very large resource. We've defined that over the preceding years. And right now we're running a demonstration plant to confirm the engineering data to be the basis of our definitive feasibility study. So in 2020, 2021, the demonstration plant was preceded by a pilot plant campaign. The pilot plant ran material from drilling programs, but for our demonstration plant, we needed to go and extract a large sample out of the ground. This sample represents material from the first 10 years of our projected mine life. Our mine life is around 20 years, and this sample comes from the deposit that's going to largely support the first 10 years of that project. And we haven't sampled from the second 10-year period. That we may do that in the future, but at the moment, the focus has been on the first 10 years to get a representative sample to confirm the engineering data. Last year, 2022, we mined this material out. We converted it into concentrate. That work finished around November last year. There's a photo there on the right-hand side showing 680 tonne of pyrite concentrate was produced. There are some bulk bags there at the front. Roughly every bulk bag contains a tonne or so of concentrate. So roughly 650 to 700 bulk bags were produced of concentrate. The average grade of that concentrate was around 4,400 ppm of cobalt. In other words, about 0.5% cobalt. The overall recoveries of that concentrator tracked really well with past performance and expectations. So we recovered into concentrate from the ore around the 90 to 95% level. Now I need to just give some explanation to that. In our concentrator plant, we have a gravity circuit. You can see there on the photo the tall towers, and if you look carefully at that photo, you can see the gravity spirals hosted there in that structure and array. So our primary mechanism for concentration is a gravity circuit. We then take the tails from the gravity circuit and put it into a float plant. So it's really a scavenger float plant to recover residual pyrite that's not recovered from the gravity plant. We spent quite a lot of effort last year optimizing the grind size. And in the forefront of that photo, you can see a small little baby ball mill. So we modified the ball mill, we tried a roller mill, we looked at different sizing of that crushing and milling circuit to then generate a range of particle sizes to put through the concentrator plant. That then gives us a really solid basis to pick the best and optimum design criteria to take forward into the demonstration plant. So I've kind of labored that point a little bit, but that principle of optimization, process flow sheet, parameter optimization is really why we're spending so long and so much effort at our demonstration plant. These are some photos of our demonstration plant in town. So once we've produced that concentrate, we bring that into town and then process it through the various steps. We have 4 main steps in our demonstration plant in town. One is the kiln, which you see in the top left. And then after the kiln, it progresses through the leach circuit. Then we produce mixed hydroxide. And after that, then we refine it into cobalt sulfate. So the processes that I want to really talk about today are the kiln and leach and MHP, because they're the key ones that we're really focusing on right now in our operation. Just going again to these photos, you've got the kiln in the top left. After the kiln, it comes out through the discharge conveyor shown in the bottom left. And then that's separated, and you can see the photo at the top right, 2 photos, a grey material being the dark grey material is the product, and the light grey material is the feed going into the kiln. So you can really see contrasting just visually, contrasting feed material and a product material. We then are able to confirm the process efficiency of converting pyrite into pyrrhotite. We're getting very high efficiencies through our kiln, but again, those efficiencies are related to the parameters. As we change temperature, as we change residence time, as we change nitrogen flow rate, we're able to vary that conversion. And so we've been developing up all those respective curves, and we feed that into our engineering team. You can see some photos of elemental sulfur. We recover relatively clean elemental sulfur out of that kiln operation. So that nice bright yellow material. That's probably at around 97, 98% pure sulfur. That still needs to go through a filter process to remove any residual gain material in there, so some particulates, and then that gets turned into prilled product. So at the moment, we're collecting what we call bulk sulfur, and then that'll be converted into prills later this year as a subsample for some offtake discussions. So there's a lot of work going on around the kiln. We're continuing to modify the parameters. We're also continuing to modify the back end. So the kiln itself is solids, but out of the kiln comes this gaseous sulfur product, and the ability to treat that, to remove the particulates with a filter, to condense the sulfur. There's quite a few process steps there. So again, we're working with vendors and parameters and our engineers on optimizing that. These photos have been shared in the various ASX announcements. Again, on the left-hand side, that's our belt filter. We use a 4-stage countercurrent belt filter to remove the leach residue and to wash it and ensure that we don't have cobalt losses going out with that residue. Then there's a photo of our pressure reactors. For our particular process, we've now settled on using tank reactors for our pressure system, as opposed to what would be more colloquially known as a submarine design. So rather than one large horizontal submarine design for our autoclave pressure circuit, we're using individualized tanks. That gives us really important advantages for heat management and to maintain the temperatures in our operation. And it also gives us much greater mixing of the oxygen gas that goes in and the solids to create the leach conditions. On the right-hand side, we've got photos there of our MHP. This is what we generated at the demonstration plant, just pointing that out that previously we had lots of samples from the pilot plant, but we've now got our first MHP from the demonstration plant, and we've also generated some cobalt sulfate. It's just worth pausing for a moment as I wrap up on demonstration plant. What's the key aim? We ran this pilot plant previously. We proved that the process worked. We sent samples out to a range of potential offtake groups. They all confirmed that the samples were acceptable from a specification point of view, from a trace metal point of view. But we really needed to go to this demonstration plant, A, for sample representativity out of the ground, to test all of the aspects of comminution and milling and how they affect concentrate production. Then we wanted to run a much larger concentrate circuit, which we've now done to confirm the process recoveries. And in the same vein, we're now running the demonstration plant in town to confirm process recoveries, to confirm equipment suitability, and to continue firming up the process design criteria. It's not that we don't have process design criteria. We've got a lot of that, and our engineers, which I'll mention in a moment, are busily working away on the design. It's making sure that those design criteria are de-risked. So when we build this circuit at the commercial scale, we have a very short commissioning time, and that all feeds back to things like process guarantees and throughput warranties to underpin the finance for the project. So this is a huge stepping stone. We see this as a massive milestone for the company, but a lot of it's all about de-risking project finance. And I just wanted to touch on the last comments from me before I hand back over, is just on our activities, our field activities. Recently, we've just completed nearly 12,000 meters of drilling. Most of that drilling was a combination of RC drilling and diamond drilling. This covered a little bit on resource work, some infill work, but largely it was drilling for waste definition. And waste is obviously a hugely important topic for an overall project feasibility. Is what do you do with the waste rock? What do you do with your tails? How are we going to manage those at site? And that's all feeding into our EIS study. So there's a lot of effort that we've done now more on drilling out waste, which our geologists are never happy about, but it's critically important information for the feasibility study. In terms of the permitting, we're just finalising the last soil surveys, archaeological surveys, heritage surveys, and we're doing a lot of surface water and groundwater work at the moment. We completed groundwater bores. They're in, so the piezo instruments are in there now collecting all of our groundwater data. So all of that's going to wrap up into EIS, and we've probably got one last round of surveys to complete in the spring season, subject to the results of our current surveys. So there's potentially a little bit more survey work to do, but largely all of the field work has now been completed for the EIS.
Thanks, Andrew. Joe, I'd like to hand it over to you to perhaps give us an update on what's happening in terms of commercial negotiations, potential partners.
Thank you, Joel, and g'day all. I've got two things I want to touch on, is the negotiations or the partner side with respect to the Broken Hill Cobalt project, but also I want to touch upon our vision of building a standalone refinery, which will refine not just the Broken Hill product, but also allow us to upscale going forward. With respect to Broken Hill, our view remains that a project partner is the ideal outcome for us, and offtake is a small part of that. So our preference is to find a partner that's willing to take a minority interest in the project and then pay a premium to enter the project on that basis. That partner will be able to then take equity offtake, but also there's a conversation or a discussion around all the rest of the offtake with respect to the project. I need to note that we've had tremendous assistance from both New South Wales, but also importantly the Commonwealth Government, and that we are very busy with respect to those negotiations. So that we were recently in Korea and Japan. We're about to go again back to Japan, this time with Austrade, and our commercial team will also be attending the CI conference, the Cobalt Institute conference in May, followed by commercial discussions in Europe. So this is a very fast-paced environment, and one where I would say that the geopolitics, the legislation that's coming out, is actually outpacing the commercial reality. And that's one of the reasons why there's a bit of a pause at the moment in the industry to digest the latest outcomes with respect to the Inflation Reduction Act and the new European Critical Raw Materials Act. Both of those acts, in terms of their guidance, have actually just come out. The EU Act in the last 2 weeks, and the IRA is actually due this week in terms of final rollout. But we remain confident. In fact, we're very, very confident that these acts will allow not just a single Australian cobalt mine, but an entire production chain feeding into those end markets. Now, whether you're focused on cobalt, nickel, or other battery metals, they will all come along for the ride. This is a tremendous industry building process. In terms of that, this new information with respect to the legislation, I don't intend to give any prescriptive guidance on our conversations with partners. I'm just going to let that roll into Q2 and not give any particular guidance on outcomes, because they are two-way conversations. The next point I want to make is with respect to our refinery. We have come out to the market and talked about a refinery, but I want to make it clear that the refinery is potentially a standalone business for us. The ability to convert an intermediate cobalt, such as RMHP from Broken Hill, into a precursor-ready cobalt sulfate adds not only tremendous margin for our shareholders, but also bypasses some of the Asian-owned refineries, which are the subject of the IRA and other acts. In other words, the pivot away from countries such as China and the pivot towards production chains feeding the EU and US directly. So our thinking in establishing a refinery in that South Perth area, the Kwinana-Kemerton area, is very simple. It will allow us to process our Broken Hill product. Processing Broken Hill product into sulfate at that location is problematic, given the temperature and the melt point of the product, etc. Doing it at a deep water port such as near Perth is much more straightforward. The other advantages there is a key part of the cost curve in converting those chemicals is chemical consumption and reagent consumption, of which Kwinana is a centerpiece. So we should have a much lower cost base there in terms of those OPEX. And third, and very importantly, it co-locates us with other elements of the battery chain. So we are the biggest form of cobalt coming, the largest project, I should say, in volume terms of cobalt coming into the market. That's our belief. Around us, naturally, nickel and manganese and other players can coalesce to create further downstream cooperation. And that's exactly what Perth represents to us. It's that availability of N, C, M all pulled together to potentially make precursor and conceivably even make a lithiated cathode, an active cathode in Perth, because the materials are there. So for all of those reasons, we will be locating the refinery in that area. The last reason is also it gives us strategic advantage, so that our first 3,500 tonnes of metal units equivalent will come from Broken Hill. But as we go forward and build a second and potentially third project, for example, a waste streams project or another alternative, then it makes sense from an economy of scale perspective to have that refined in one location rather than having separate mine refineries scattered around the Australian geography. So that's a final point as to why a singular refinery focused on economy of scale and high quality product is in our interest. Thank you, Joel.
Thanks, Joe. We'll open it up for questions here in a moment, but I would just like to spend a few moments, because of the pre-submitted questions, around half were around the cobalt price and sort of the outlook. So I'll just spend a few minutes discussing that. Look, having a look at this price, you can see that all three key indicators of cobalt product are around 2 years lows. Fortunately, it does appear that there are some early signs of a rebound, with prices finding a bottom and I wouldn't say starting to rally, but certainly ceasing their decline. Why has cobalt come off so sharply in the past 6 to 9 months? Though it's simply put a period of surplus supply or greater supply growth than demand growth that really pressured those prices. Supply has grown at a CAGR of around 14% in the 3-year period between 2020 and 2022. And there's another big year of growth this year as well. This is at a time when demand was roughly 6% over the past 3 to 4 years. Demand growth at 6% in any commodities is actually a pretty fantastic outcome. And given what we know about EVs and the demand for cobalt and batteries, it's certainly a good number. But when you've got supply coming in at the pace that it is, you're certainly going to see pressure on prices. So where is that supply coming from? It's almost primarily out of the DRC in Central Africa and Congo. There are 5 projects that are ramping up. 2 of them owned by Glencore and 2 of them owned by Chinese entities, and they're coming in fast. Now, don't forget, these are primarily copper projects, and we know copper has been a favorite of the market for many, many years. So getting copper out of the ground is a priority for those major producers, and obviously a byproduct of that is the cobalt. And these are very large projects, and supplies coming to market. That supply growth, that phenomenal supply growth, will end over the next 12 to 24 months, while demand continues to grow at that pretty steady pace. So we do expect price recovery, a sustainable price recovery over the next year or two. I think for the next 12 months, I wouldn't be expecting prices to go back to where they were last year, but it does appear that we found a bottom as those prices really start to test marginal cost of production. Simply put, it's a lot of supply to take for any commodity to take in, but demand will begin to outpace supply over the next 12 to 24 months in our view. Obviously, our share price has a pretty strong correlation to that price chart. So I think any questions regarding the share price and what the outlook, sort of a lot of it depends on the comments that I just made on that. Okay, we'll wrap up our presentation there and open it up for questions. Andrew, you mentioned some partners in the DFS. Can you give us a little bit more clarity on who you're partnering with and sort of the frequency of the relationship?
Sure. Thanks, Joel. Thanks for the question. For Cobalt Blue, our development trajectory has been through scoping study, pre-feasibility study, a pre-feasibility study update in 2020. As we move into DFS, it was very clear to us that to get this project financed and off the ground, we'd need to bring in the right engineering teams to be engaged with that. And so we went through quite an extensive selection process. At the end of the day, we selected Worley for the process plant design, SRK on the geology, resource and mining components, and GHD on the non-process plant infrastructure, waste management, EIS systems. There's quite a lot of activities that Cobalt Blue are doing in-house, covering things like marketing, offtake, HR, recruitment, and so on and so on. But that's the core of our DFS team of those three outside engineering groups, Worley, SRK, and GHD. If I can just focus on the process plant, because this is coming to one of the key external risks, I guess, for our project has been, does the process work and can you go build a plant that will do the process to the conditions that you want? So part of the demonstration plant last year was, once we had that base of pilot plant, was to go to these engineering firms. And as I said, we selected Worley. And so most of last year, we had Worley coming out to us roughly once every 6 to 8 weeks. They'd engage with our team, our design team, our operators. They'd come to Broken Hill, look at our build, and they'd inform us and we'd inform them. So it's very much a two-way discussion around how to set up our demo plant, what data we want to collect from it. And I'm just going to, excuse me, as I look down, I was going to read a couple of stats. We've got just in one component of the plant around the leach circuit and MHP circuit, we've got 55 pumps. We've got 30 control loops. We've got nearly 750 data points being collected on our SCADA system, which is a Honeywell commercial grade SCADA system. And in terms of sampling, we take nearly 40 samples every 12 hours. So slurry samples and so on. So those are just some quick metrics around the depth and extent of this demonstration plant. And that's just talking around the leaching to MHP circuit. I haven't included kiln and the concentrator before that. So for us, it was really important to embed Worley into that stage. And now, as they're doing this year, the detailed design, doing 3D models, vendor selection, and so on, they're really pushing ahead, and we've got an excellent working relationship with them. So that augurs really well to have a credible feasibility study, and let's see where that relationship takes us as we move forward with the project.
Thanks, Andrew. Yeah, a lot happening with the DFS. That's why we thought it was important to take the time to publish that report last week and answer questions here today. This one's probably aimed, either you could answer, but maybe give Joe a little bit of airtime. What's the current thinking on CapEx?
Yeah, thank you, Joel. Look, the last time we published a pre-production capital number was July 2020 as part of our then project update. That's in the public domain. That was in Australian dollars, $560 million. There is no doubt, and we have been clear about this for the last 6 or more months, that the DFS that we'll be delivering in 6 months' time will effectively have an inflated capital number to that. What's that number? Plus 20, plus 25%? I don't know, and even those numbers are a guess. So we are telling the market that we are not immune to the capital issues that are plaguing the market. What I might do is just turn back to Andrew. There's one thing to say, look, there's an inflationary period ahead of us with respect to equipment and services. But I think it's important for investors to understand what we're actually doing about that, because there are a number of levers that we can pull or target to try and mitigate those effects. So maybe for Andrew, turn to you.
Sure, thanks, Joe. I guess I just wanted to make 3 very quick comments. First of all, when the DFS is completed, we'll have our updated capital cost to put to market. So until then, it's very hard for us to provide firm guidance or even really soft guidance. In terms of the inflationary environment, that continues to evolve. It's an interesting, when you look at the details of the inflation environment, it's a very interesting aspect. Are you talking shipping? Are you talking underlying steel cost? Are you talking labor? Are you talking regional development costs? All those sorts of things feed into that headline inflation number. For us, as a project, the execution strategy, so how we're actually going to build the project, how that's going to come together, that piece of planning is going to be included in our DFS. But that normally happens towards the end of the DFS when you have all of the information at hand. So once we identify, for example, the vendor supply packages, and with those vendors, we work out exactly how much pre-packaged equipment they're going to make at their factory, then we can work out the logistics chain. Most likely for this project, we're going to have a logistics hub outside of Broken Hill, for example, at one of the ports, that we may have that as a staging area, bring most of the offshore or around Australia, but not from Broken Hill equipment into that facility, and then bring that up in a cost-effective logistics chain. Those are some of the sorts of things that we're looking at: pre-packaging equipment, logistics chains to reduce on-site fabrication costs. The second part of the overall inflation question is ultimately one of the biggest line items for any project this scale is all about the people. It's not so much how much is the ball mill or the pump cost. That goes up and down a little bit. It's actually how much is the people to install, to fabricate, to tie it in, to do the electrical work, to do the piping work. And so that's a piece that we're working really hard, both with Worley and GHD primarily, to think through how can we pre-package as much equipment together. How do we bring that on site? How do we logistically and systematically lay that out? So there are a couple of the comments that we're feeding into that story, but we'll have a CapEx number towards the end of the DFS that we can publish.
Thanks, Andrew. Just on sort of the back of that question, we had a number of questions or comments asking for our opinion on what's happening from an announcement from one of our key peers today. I might just take that. Look, we don't comment as a rule on the activities of our peers, but I would just say that the business model that we have versus that particular group is very different, especially considered we're an integrated mine and refinery. So it's a whole different story. And as we just heard from Andrew, he's thinking very long and hard about how to reduce and de-risk the inflationary risks there. Joe, you touched on it briefly, but can you just flesh out a little bit more? What does the IRA and the new European Critical Raw Materials Act mean for our business?
Yeah, look, I thank you for the question, and there's no way I can do justice to the question in what will be a fairly short soundbite. The IRA uses effectively hard US dollars in a directed funnel effect to try and build not just mines but production chains. It incentivizes sourcing, extraction of critical minerals, so not just the battery side, the raw, the rare earths, etc. It incentivizes processing in allied countries, FTA and other like-minded countries. It actually tries to make up for what has been 2 to 3 decades of the US taking its finger off the pulse and building its own dedicated supply chain. So 2 things from a political sense are driving that at the moment. One is the COVID period where we had supply chains broken and key components withheld from manufacturers, and that caused massive disruption. And the more recent issue is with respect to the war in Ukraine and its effect on supply chain. So the US is saying enough's enough. We're going to deploy hard dollars to find the materials, refine them. We're going to do production tax credit initiatives where they will actually help compress the cost of making the batteries, and based on the forecasts, compress the cost of the batteries, the cell, if you like, to below that of what's required to be cost parity with internal combustion engines. So this is almost a fait accompli in the sense of how much money they're putting at it and what the outcomes will be. And the hurdles to participate will get higher. So this year, I think, Joel, it's 40% you have to source from FTA, and it goes up 10% per annum. So there's a huge window, quite a material window for a new participant, particularly an Australian-based participant, to come in there and be part of that supply chain. The Critical Raw Materials Act from the EU is much more recent, in fact, only just been published. It doesn't deploy the firepower the US does. Bear in mind, the EU is an amalgam of 20 plus countries. It's not a singular government with singular budgets that the US has. But it looks at prescribing limits of what it needs to make internally, source from its own sources, what its dependencies are on external sources. In other words, you can't be beholden to one source. Recycling limits is another major one there. But basically, it describes targets for what European industry should achieve. More recently, Joel, the two governments have got together and I think tacitly agreed that EU produced componentry and or raw materials will actually complement and will satisfy the IRA. So there's a huge amount of collaboration. What does all that mean? It means we're in probably the most exciting period in this space with respect to critical minerals that, certainly I can remember. And it's very rare to say this, but I think the politics are outstripping the commercial realities, and the commercial realities will spring back quite sharply on this.
Thanks, Joe. Yeah, and just on, as you mentioned, the collaboration, the continuing collaboration with looking like the EU will be able to qualify for a lot of the IRA incentives. Obviously, this morning we got news that looks like the same will be true for Japan, with Japan and US signing a similar act. So that global cooperation is really just establishing a whole new supply chain that we're lucky enough to be right in the middle of. So that really is what that means for Cobalt Blue. Got a lot of questions, sort of market related, that I might take a moment to, particularly worries around stockpiles or stories of stockpiles in the DRC at the 10K mine. For those not aware of the situation, it's a mine operation owned by CMOC or China Moly. They have a dispute with the DRC government where they have not been able to export any of their materials since July. It's a very large operation, so they're starting, and it hasn't ceased operations. And there is obviously a lot of finished material just building up. So there is concern in the market that this material hit the market and all at once and perhaps negatively affect price. Look, this is not an unusual situation, particularly in jurisdictions where there is often conflicts between miners and the governments. So we've seen it before. Generally, what happens with these stockpiles, well, first of all, they are a known quantity, so it won't be a surprise to the market. Second of all, usually this material has already been in contract. So CMOC would have had to go into the market and try and replace the material that they had promised to their commercial partners. So when that comes out, it's not like it's going to all of a sudden hit the spot market. It's going to go to where it was initially contracted to. And finally, I guess my last comment would be, it's very difficult, even as it is, to get material out of the DRC. It's just a very tight bit of infrastructure, essentially trucking down to South Africa. So it's not like that road can all of a sudden expand and all this material can come out all at once. It's not simply just not a physical reality. So to answer the question, do the stockpiles at 10K worry us, and do we think that it'll have a large impact on pricing? No to both of those. Maybe return a little bit more at the project level. Andrew, you touched on it briefly, but there's been a number of questions asking to clarify a little bit on how the demonstration plant performance is tracking versus your team's expectations.
Sure. Thanks, Joel. So as I said a little bit earlier, we need to break that question down into the subcomponents of the plant. So the first part, like if we take a holistic picture, the first part is when we put that portal in, did we find ore where we thought it would be? And the answer was yes, unequivocally. It was interesting when we did that, just how clear the waste ore boundary is, and that has implications for mining in terms of ensuring that the mining is as simple and as cost effective as possible. If we ended up finding that the boundaries interlaced with one another, then it starts to affect your dilution. So we found a nice clear boundary. So that's step one on recovery. The second step was the concentrate work really proved up that we can get those high recoveries that we had seen earlier in our development path. So 90, 95% out of ground into concentrate. Now I'm giving a bit of a range there because it does vary a little bit, but those are the sorts of numbers that we saw at pilot plant and in the lab in the early work. And now we've confirmed that with that 4,000 tonne trial. So very, very credible recovery number to take forward as concentrate. As I keep saying to our team, if we don't get the concentrate right, then the rest of the plant becomes less relevant because you can't catch up. So you've got to have very high recoveries from ore to concentrate to underpin the economics. The second bit then is what's a conversion in our kiln? In reality, the kiln product, if it is able to be separated into a stream that goes ahead into leach and a stream that's recycled. So the kiln efficiency is not a recovery, it's an efficient number. How much is recycled versus how much advances? So we're working on that, and that's showing that we get efficient conversion of 90, 95% as we had expected, which means that there's a small amount recycling around. And so then that affects the size of the kiln, but doesn't affect overall recovery. We're working on the leach performance at the moment. We've had a range of results come out of that. Some, again, have been as expected in the high 90s for breakdown of pyrrhotite. And when we haven't run properly, it's been sort of 85%. But again, we keep optimizing those parameters and changing the size of our leach, making it bigger and smaller. That's one of the advantages of demonstration plant with those tanks that I talked about before. So we can take tanks out, put tanks in, we can change the residence time from 20 minutes to an hour to 2 hours. And obviously, as we change that, you get a different performance curve. So that's still a work in progress, but overall, the results and recoveries are pretty much what we had at pilot plant, again, confirming that the process works and it's scaled up appropriately.
Thanks, Andrew, and congratulations to the team. You guys obviously worked very hard to achieve what you have so far. Well done. Another very popular question is, can we just clarify the timeline? When is the project expected to be in full production? Maybe someone, either you or Joe, could just spell that out a little bit.
Sure. I wanted to make just two very quick comments. At this point in time, we're still anticipating having our project up and running by early 2026. I'm being a bit hazy there because it's only at the back end of the DFS when we have that very structured construction timetable that will have greater clarity. So we'd be expecting the timelines and so on to be updated. While we can sit here and develop a timeline, at the end of the day, it's reliant obviously on our what I call EPC, and we're not certain that we're doing EPC or EPCM or a design and construct, many different contracts. Don't worry about that. But the point is, until we actually appoint those groups, then our timeline will continue to evolve a little bit. That's why we're saying early 2026, but it could easily move around and we'll have greater clarity towards the end of this year as we identify and confirm that construction plan.
Thanks. So guidance hasn't really changed over the past couple of years. It's still on track. That's good to know.
Correct.
There have been a number of questions still on to you, Andrew. Sorry, pressure's on. A lot of people wanting to know, what are the costs associated with producing the final products, MHP, sulfate? How's that tracking?
Again, I'm just going to go back to our historical numbers as I did a little bit on the CapEx side. Obviously, all the operating costs, full project, not just process plant, full project mining, water supply, power supply, everything will be updated in our DFS. So end of this year, we're going to have updated guidance, which people can then rely upon for project finance and investment decisions. Up until then, our public documentation is around what was published in 2020. At that point in time, we had somewhere between $10 per pound and $12 per pound, give or take a little bit on FX rates for the production of MHP and cobalt sulfate. Again, we expect those to have increased a little bit over time, but we're not expecting those to be wildly different from that. And I guess underpinning that, if we talk specifically about one aspect, power in the process plant is roughly 30 to 40%. Power price has changed a lot. However, at an industrial level, the power price that we're negotiating in our power purchase agreements is largely the same as what we had previously. So not expecting power to be double or triple or anything. It's largely in line with what we had a couple of years ago. And so we expect a small amount of inflation on operating costs, but not wildly different to what we had.
Joel, could I just add something to that? And it's a question I think all of us get. It's the where do we stand on the cost side of things? Now, I think we've been clear in the past that being a byproduct, having a cash cost curve for a byproduct is largely a nonsense, because clearly as the copper price goes up or the nickel price is affected, you get a major swing in what the byproduct cost is. But I will say that based on the Q4 release from the Cobalt Institute, so they do a holistic view on average production costs. And in this case, I'll talk about cobalt sulfate. So this is the average production cost of cobalt sulfate in Q4 calendar 2022. They've nominated a number of around $22.70, so $22, $23 a pound US. Now, what Andrew's just told us is based on admittedly a PFS certainty, not an FS certainty, of around $12 to $13, tells you, I think, we're looking extremely well positioned with respect to entering the industry, and will make a considerable margin versus the average of our peer group. And that average of that peer group, I would point to you as the IRA and EU acts come in, will actually increase, because these will be new projects, right? So I'm really comfortable with where we're at today with respect to that cost side. Thank you.
Look, we're nearly out of time, so I think we'll just do one more question, and I'll take the honors, gents. I hope you don't mind, but it's a very enduring and popular question, which is, can you touch on the risks around thrifting cobalt away from NCM chemistries to LFP chemistries? We've touched on it a lot in the past, but continue to look into it and speak around the industry, and we still feel pretty comfortable with where how the market is evolving. So just for a bit of background, over the past couple of years, the share of non-cobalt, nickel and cobalt bearing batteries in the market has grown quite substantially versus how much the share of nickel and cobalt bearing batteries, which today stands around, on a global basis, around 70%, anywhere between 25 and 30% is covered by LFP or lithium iron phosphate type chemistries, which are very popular in China, not yet popular outside of China, but we do know of a couple of plants being planned to build that type of chemistry. Look, we think that it is only natural for a market like this to evolve and probably de-risk. We all are very aware, anyone on this call I'm sure is aware of the volatility of both the nickel and cobalt prices, and that worries not only battery producers, but consumers as well, because there's price involved. But at the end of the day, we're talking about batteries and we're talking about performance. And NCM chemistries, or chemistries with nickel and cobalt, just have a better overall performance, particularly for Western markets, who the number one concern is range. In fact, UBS just put out a piece this week where they surveyed over 40,000 consumers, EV consumers, and the number one concern was range. And LFP just cannot give the same type of range that NCM can. Now, in high density cities, like many in China and across other major economies such as India, maybe the rest of Southeast Asia, that type of chemistry may actually work for them. That's fine. Our modeling that we base from some of the key third-party consultants out there shows that cobalt consumption, even despite the fact that NCM battery share has declined, will double every 4 years. over the coming decades. So even with that decline in share of batteries, cobalt demand in batteries just continues to rise. And that's why we're putting together this project, because we know that it will be required, particularly in the timeline of when we hit final production. All right, well, we've ran over time. I thank everyone who's stuck with us. Thank you for all the questions. If I did not get to your question, please feel free to reach out. We're very happy to spend some time over an email and answer those. And we hope that this was an informative session for you. We're just trying to keep as much information out there, particularly as we head through this really important part of the journey, which is producing the definitive feasibility study. And so you can expect more updates as it progresses. So on behalf of Andrew and Joe and the rest of Cobalt Blue team, I thank you very much, and we'll end the webinar here. Thank you.
Thank you.
Thanks.